Welcome to Lunch Money. Coming up, the Bank of England holds rates again. What does this mean for you? Should savers fix now? And stick around to find out whether the Fed's rate hold is good news for investors. Hello, I'm Simon Lambert. Joining me on today's Lunch Money is This Is Money's Lee Boyce and Victoria Scholar from the show sponsor Interactive Investor. Lee, the Bank of England has held the base rate at 5.25% for the third time in a row. We're going to get on to what that means for people in a minute. But first of all, was this a surprise?
It wasn't a surprise in the slightest, I'll say, Simon. Lots of economists expected this. We had the rate freezes in September and November, and that came off the back of 14 consecutive hikes. So I don't think it's not caught anyone by surprise that there's been another pause just before Christmas as well. And also, we've got to remember that inflation has been coming down. That's the whole point of raising rates is to curb inflation, and inflation has been coming gradually down. So it peaked at 11.1%. It's down to 4.6% in the last reading in October, and the last time it was lower than that, or around about that same rate, was October 2021, and at that time base rate was at 0.1%. So I don't think it's caught anyone by surprise. It's what happens next into 2024 is what everyone will be watching.
Yeah, we talk about the rate hike cycle, don't we? And we're actually now 2 years into that. It first moved up in December 2021 after sitting on the floor for so long. I guess the question now is, have we peaked? And then also following on from that, is it too early to be talking about cuts?
I think that the general consensus is that this is the peak, and the sort of noise coming out of the city today really is that there could be cuts as early as June. That's the new talking point. That seems to be the new kind of target people are talking about. It could come earlier than that, it could come later than that, but June seems to be the general consensus. Previously pricing in a 0.75 percentage point decrease next year. That's now nudged up to about a percentage point instead, which would bring it down to 4.25%. A lot of what ifs there. We know that things can change on a penny, global events and things that can cause more inflation. We've seen energy prices fluctuate, petrol prices fluctuate, things that we spend our money on a daily basis, food price inflation is still high. So there's all these things still in play, but the general consensus is that there will be between a 0.75 and 1 percentage point drop next year.
And with the caveat that people have to be incredibly careful about reading too much into any of those forecasts, bearing in mind that during the inflation panic over summer, base rate was going to hit 6.5% apparently by the end of this year. We're going to look now at what this means for borrowers and savers. First up, mortgage borrowers. What does it mean for them? And if people are looking at the need to take out a mortgage right now, what should they be doing?
Well, the mortgage market has improved somewhat, Simon, actually in the last few months, and a lot of that has been because of the steadying of the rate hikes, and lenders have been more competitive as we've come towards the end of the year. So all of the major lenders have come into a sort of mini kind of mortgage price war. You can now get a 5-year fix for 4.29%, for example. 5-year fix, best 2-year fix at 4.65%. That's quite a lot lower than what we were seeing in the summer when those panics over a sort of 6.5% base rate were out there. And also, it depends what mortgage type you're on. So if you've got an SVR, for example, you would have seen your rate go up a lot this year, typically now between 8 and 9% SVRs. But where we've had this pause today, it's unlikely that there'll be any movements because usually it's linked to what base rate is doing. But if you're in the market for a new fix, maybe remortgaging, or perhaps you're just a first-time buyer, mortgage rates have improved somewhat, and you would suspect that they've kind of plateaued for a time, and you would expect that going into next year as well, especially if we're talking about economists pointing to base rate having peaked and steadily coming down.
And I guess there's a risk that people thinking, oh, well, rates are going to come down, so I'm going to sit and wait, are A, taking a gamble, and could be, if they're shifting onto a standard variable rate, be costing themselves lots more money while they do this wait and see approach.
Yeah, and I think that a thing to point out here is that it's very unlikely that we will see mortgage rates of between 1% and 2.5%, which is what we were kind of seeing from 2021 and the decade before that. A lot of people have got used to that ultra low rates that were on offer. It's looking likely that 4 to 5% for the best rates are here to stay, but you might even be facing higher rates than that. If you sit in your hands and wait, you could end up costing yourself, as you say, going on to a pricey SVR. If you think there's going to be massive cuts incoming, it's quite unlikely. I think mortgage experts are saying this is where it's going to sit for a while, it appears.
So that's borrowers, for whom a pause is good news and the hope of rate cuts is good news. But savers, on the other hand, of which there are many in this country, aren't going to be so happy that rates have stopped rising, are they?
No, I think there's good news and bad news for savers at the moment. I mean, we've come into the end of this year with inflation slowing, and that means that there now are savings accounts that beat inflation for the first time since we had ultra low rates. But it does appear that savings rates have peaked. So we had that NS&I 6.2% one-year deal a little while back, which just blew everyone out of the water, stuck around for a while, hoovered up loads of savers. We're now on a Best Buy one-year fix of 5.7%. So we're talking about a 0.5 percentage point swing there in terms of what you can get for the best deal. So it appears for fixed rates, we've definitely reached the top and they're gradually coming down a bit. I think the news on that, though, is that a lot of people that would have required a fix would have done it by now and gone for it. And if you are in the market for a fix, you're just not going to do quite as well as what you could have done before. But quite interestingly, the gap between the best one-year fix and the best easy access has shrunk somewhat. So the best easy access at the moment is 5.2%. So it's not a massive difference now between fixing for 1 year and having an easy access account where your money is just at hand. You're not having to lock that away. And actually, I crunched some figures before we came on the show. On a £10,000 pot, you're talking about a difference of about £50 between the best 1 year fix now and best easy access. So I think a lot of savers will be out there thinking, the fixed boom might be kind of over a bit and might be looking more towards easy access. If you look at the figures from the Bank of England for this year, the amount of money that's poured into fixed rate accounts is absolutely astronomical. People have been taking advantage of the really good deals that have come out.
Okay, and just before we finish, a couple of the pros and cons of those fixes versus easy access. I guess the problem with the easy access account is that you might find that they, instead of increasing your rate, as people have been finding over the past year, they might decrease your rate over the next year, which might be a reason to fix. But then on the other hand, you might have some easy access accounts that guarantee you a certain rate, but they also might come with some traps that mean that you can only make a certain amount of withdrawals, so you might as well fix. So what should savers think about in this position?
Yeah, it's got a bit more complicated actually in terms of the best rates, Simon, I would say. You have to be careful of all the kind of issue numbers that come out. You can look on a bank's website at all the different issue numbers and there's just dozens of them sometimes. So you want to make sure that you're in the very best rate that your bank is offering you. If you're considering a fix, do you have that easy access emergency cash at hand? Because you're not going to be able to access that money and it's very unlikely that you will be able to do so without a big heavy penalty. So you need to weigh up those decisions. You also need to look at how your ISA savings going, for example, as well. So ISA rates have gone up as well as fixed rates and easy access. You don't get quite as good a rate on them, but it could be worth it so you don't breach your personal savings allowance limits, for example, if you're going to earn a certain amount of interest. So you want to make sure that you're maxing out your ISAs. But I think the worst thing you can do is, and I'm hoping there's not many people watching this that have still done this, has done nothing. We did have a good 5, 6, 7 years of the best buy rates being like 1 to 1.5%, which is just, you're not really making any, that would be the argument to someone, I don't want to open a savings account because I'm going to earn £10 of interest on, £1,000 or whatever. But we're in a different scenario now in which there are actually really good rates. So I think the worst thing you can do is just do nothing. And you'll be surprised actually how much inertia there is in the savings world, which is a shame because it's never been easier to tap a few buttons on an app and move your money around. Even if you went into a bank's rate, which, they are pretty rubbish, but at least you're doing something. A lot of people just park cash in current accounts doing nothing. And I think that is a real shame.
That's where they're losing money. Thank you very much, Lee. Victoria, last night we had some people who were doing nothing. Another interest rate decision on the other side of the Atlantic, and it's the US that sets the tone for the rest of the world. The Fed has held rates for the third time in a row. What did it say?
Well, Fed Chair Jay Powell seems to have shifted his tone. He's now saying that the Fed is likely at or close to the peak of the tightening cycle. And this has opened up a discussion about potential cuts to the borrowing rates, with the possibility of 3 rate cuts in 2024, bringing interest rates back below 5%. He also said that growth is moderating, but the labour market is coming back into balance and inflation is making real progress, which suggests he believes that this soft landing theory is likely to play out.
So have we definitely reached the peak now?
Well, not definitely, but it is looking increasingly likely that the Fed is done with rate hikes. This meeting has seen a major shift in the language from the Fed away from leaving the door open to further hikes towards the most likely scenario being that we are actually at the peak. Powell said that rate increases were not the base case anymore. So I'd say the door is sort of ajar now, but much closer to being closed than it was a couple of months ago.
And what does this mean for investors? Presumably they're very cheered by this scenario.
Yes, well, this is good news for markets. We saw a rally in stocks and bonds with a fall in US Treasury yields. The S&P 500 gained 1.4%, and we saw that the Dow Jones hit a record closing high. The US dollar pulled back to a 4-month low, and those Treasury yields retreated hand in hand with a rally in bond prices. But the possibility of rate cuts next year provides a real reason for optimism and risk appetites. That's why we've seen this rally in US equities, which of course is positive for investors after a cautious period where interest rates have largely been going up. Also, there are lots of reasons to be optimistic towards the bond market too, with rate cuts pushing, or the potential for rate cuts pushing yields lower, and also a growing risk of recessions and sort of disappointing growth outlooks for a number of economies. That tends to drive bond buying. Goldman Sachs has actually hailed 2024 as the year of the bond.
So it sounds like Jay Powell put his Santa hat on and gave the US market a boost. If it continues to run on from that boost into the new year, will that give a lift to the UK stock market too, do you think?
I think so. I mean, we're seeing even just today that the rally in the US is having reverberations across global markets, including the FTSE 100 and the FTSE 250. But also, like you say, the Fed tends to set the tone for global monetary policy making. So if the Fed suggesting that it could be setting itself up for cuts next year also means that the Bank of England could follow suit, then that's going to mean lower borrowing costs for UK businesses, which of course makes British equities more attractive.
Thank you very much, Victoria. That's all for today's Lunch Money. You can catch all the previous shows by searching for This Is Money on YouTube. And if you're watching there, please do us a favour and hit the like and subscribe button. Or come to thisismoney.co.uk/lunchmoney. And that is also our final show before we take a festive break. We'll be back in January. Thank you for watching Lunch Money and have a Merry Christmas. Goodbye.